Today, you're going to hear 4 names of stocks that you can buy if you have $100,000. And to make this more interesting, I'll rank them into $10,000, $20,000, $30,000, and then the last one, $40,000. This shows you my conviction, so watch right to the very end. Hi guys, welcome back. Without further ado, let's start with the first name for today, which is actually Raffles Medical. Now, Raffles Medical is actually a household name if you are in Singapore. They operate hospital chains such as the one in Bugis Junction, Raffles Hospital, as well as Raffles Clinics. The story about Raffles is that right now, its share price has plunged quite recently. In fact, on 3rd of November 2023, it actually dipped 15% in that week itself. The reason for it is because group profits for third quarter 2023 actually fell by 67.4%. So why exactly has performance been dropping? Isn't healthcare stock supposedly very defensive and evergreen? The reason is because pandemic, they've actually made a bit more money, is correct. But after pandemic, that's where actually normalization has taken place. The stellar performance in 2022 cannot be repeated immediately. If you were to look in terms of its overall profit and revenue growth trends, you would see that Hospital Services Division is its biggest pie. It's been growing steadily, correct? But we have to expect that this very defensive sector is actually a very slow growth sector. From a quick glance, the growth rate is just a couple of percent per year only. And it's actually this one below, Healthcare Services Division, that's actually seen a skyrocket in 2021-2022 and then a drop back to earth in 2023. This, of course, is his healthcare chain. After the pandemic, Raffles Medical actually benefited with a lot of COVID-related services. And that's why earnings were actually boosted in this period. Although it's a big drop from 2022, I would still say that this still can be a consistent grower. The surprising thing when you look into Raffles Medical's books is that it's actually not super profitable to earn chains. Doctors make a lot of money, staff cost a lot in general. So these are pros and cons owning a very defensive sector. Because growth is slowing in Singapore, my understanding of Raffles Medical is that it's been expanding regionally. Right now, you can actually see clinics in Indonesia, many parts of it. You can even see Vietnam, you can even see Cambodia, Japan, and more importantly, China. They have clinic chains in China and they are also penetrating the hospital segment over there. That is very important if you want to be a Raffles Medical investor, because these 3 hospitals are going to be a foundation to how they break through into the Chinese market. They have the Raffles Hospital Beijing, Raffles Hospital Shanghai, and Raffles Hospital Chongqing. As mentioned in the financial report, the cessation of the zero COVID policy has meant that there's resumption of normal services in its hospitals. Raffles Medical continues to incur gestational losses, because when you're a new hospital, the usage rate is just not up to par. People still need to know you. You still need to work with insurers, ambulance chains, etc. etc. But it seems that things are on track. Raffles Hospital Beijing has been officially incorporated into the international hospital system in the Chaoyang district. Originally, I would have thought that Raffles Hospital can make profits from its China inroads because it's been quite a while already. But looking deeper, the expectation for profits need to be 3 years later. As mentioned over here, management maintains its guidance of EBITDA break-even in 3 years from financial 2023, which is its first year of operations, which means still loss-making for the next 2 years. So what that means in simple terms is that if you're a Raffles Medical investor, expect slow growth in revenue, losses in China might continue to drag for at least for 1-2 years ahead. That's why Raffles Medical is priced right now at a supposed cheap rate versus yesteryears. Hopefully that clarifies the opportunity as well as the risk, but I have something good to share with you. And that is, Chairman has actually been purchasing Raffles Medical shares aggressively. Ever since February 2024 all the way until May, he has made at least $23 million worth of his own money into his own stock. If this isn't conviction, I don't know what is. Of course, he's a very long-term investor in his own company, but in my opinion, that gives certain backstop to Raffles Medical's share price. There are pros and cons, and that's why I weighed it as the first name using $10,000 only. Before we get to the second name, I'd like to do a quick shout out to my own new ebook, 28 Days to Financial Freedom. Inside it, I have chapters that teach on investments. So if you are looking to learn a bit more on financial freedom and investing, look for this book. I've spent countless of hours working on it to provide you a good foundation. Thank you, and with that, let's move on to the second name, which is actually the blue chip that I've mentioned right at the start of the video. And this is none other than SATS. If you haven't checked in on SATS, let me give you a story on what it has been through, okay? So SATS was once a very steady dividend blue chip company in Singapore. If you use Changi Airport, you would have seen their cargo services, you would have seen their terminal handling services. They have even extended it to the cruise segment itself. Therefore, before the pandemic, SATS was making around $2 billion and generating consistent profits worth around 200 million. Very, very stable, very, very high margin service business. But what happened during the pandemic? They've actually started making losses, correct? The reason is because aviation started to see a big shutdown. SATS at least does not own aeroplanes like SIA. Therefore, they didn't incur big losses. They had to lay off staff to cut costs, but for these few years, they've incurred marginal losses. Right now, the tide has turned already. But before we get there, let me show you how lucrative it is before the pandemic itself. You would see that this is in 2019, and SATS owns two key services, which are food solutions and gateway services. Things that I mentioned just now. The profit margin over here is lucrative, correct? Around 10 to 20% depending on year. And there's some barriers of entries to its business. Over there, I pasted a note. In the latest results, food solutions earnings before interest and taxes was only 27.5 million versus 133 million back before the pandemic. That means that this has still a lot of room to expand back to its heyday. Food solutions is still going to be there, it's not going away, so I'm pretty confident that this margin will expand back. So let's see back SATS trajectory. Before the pandemic, it was a boring blue chip defensive company, growing at a compounded annual growth rate of 2.3%. Slow and steady? Never mind. But in this pandemic, they've seen a shock. I would be very happy to buy SATS right now and place it as the 40,000 position because I believe they will recover back to its heyday. But there's a good and possibly bad problem, which is this blue zone over here. They are taking off, correct? And the reason for it is because they've acquired a company, WFS, and moving forward, they are going to be a lot more into cargo handling. This is a mega acquisition. It's in fact going to transform the company, good or bad, and lift its total revenues, as you can see over here, to a magnitude that it hasn't seen before. In fact, latest results for financial 2024 has revealed a record-breaking $5+ billion of revenue. Again, previous years was only 2 billion. Right now, 5 billion because of the acquisition of WFS Group. As you can see, air cargo right now is 429%, signifying a massive jump. The rest of segments, flights, flight cargo handling, PAX, which means terminal services, as well as meals, are still on the recovery leg. But this air cargo integration is where it's transforming, hopefully to a phoenix. The problem is Uncle Josh here is very cautious against transformational ideas. Yes, there are situations whereby indeed it becomes a bigger company than ever before and do much better, but there's also a risk that this whole integration doesn't work out well. I've seen too many examples of a big fish swallowing another big fish, and then the synergies and operational profits just don't pan out as forecasted. As you can see, this chart over here shows you the transformation. Before financial 2020, SATS was 80% a Singapore-based company with mainly 55% from food solutions. Today's SATS is going to be relying a lot on America and Europe, Middle East and Africa. 49% of business will now be relied on cargo handling. To acquire WFS, SATS has actually taken on a lot of debt. That's why I'd like to highlight the risk first. The net debt to EBITDA is now at 3.9 times. And I hope that moving forward, if SATS can make profits, they have a plan to pay down this debt ratio. The interest environment right now is not as forgiving as 2020. So this cost of debt, I can't really see from its latest results. I'm taking a bit more caution with it and placing it at the number 2 place with $20,000. Something good to add is that STARR right now has declared its first dividend ever since the pandemic, paying 1.5 cents. In previous years, STARR paid up to 18 or 19 cents. So if things recover back, today's share price of STARR would reflect a massive dividend yield. Let me know in the comment sections if you're a STARR investor and if you agree with the analysis so far. With $30,000, let's move on to the third name for today, which is actually a small cap player. This company owns properties in Singapore, Malaysia, Australia and UK, and their properties relate to dormitories for workers as well as dormitories for students. This company is none other than Centurion. Centurion started off in Singapore and has gradually expanded globally. Its bread and butter is the orange one, PBWA, which is purpose-built workers accommodation, and Singapore is the bedrock, owning 27,000 beds for dormitory workers. During COVID, they actually made some money also because, dormitories had to do a lot of segregation and stuff, and they are one of the leading players managing dormitories. They've since moved their niche to own PBSA, which is student accommodation, especially in Europe. I forgot to mention about Malaysia's beds, which is 27,000, but when you look in terms of the total revenue and profits, you would realize that the UK student accommodation, even though they have less beds over there, is actually the number 2 contributor. Actually, this acquisition has been a smart move. If I remember correctly, when SPH was selling away its assets, this student accommodation in UK was a priced one that many groups such as Kappa was trying to bid for. It goes to show that UK accommodation may have some supply-demand imbalances, which is favoring them to be able to raise rates consistently and get good occupancy. So Centurion has had the foresight of moving there early, and this has been a key contributor after the Singapore dorms. Let's look at the latest results. You would see that revenue has increased by 15%, and they have mentioned specifically that they have increased occupancy and positive rental revisions across all countries. So that's fantastic news. Good operational performance. Net profit from core business grew by 20%, and net profit leaped 131% based on a fair value gain. Let's exclude that from the equation because the core business is what you need to factor for. Fair value gain is just the property value just increasing. It could decrease in future also. So that's why dividends cannot be paid out from there. The core business, however, gives you potential dividend upside. From the core business itself, the net profit margin, as I boxed up, has inched up to 37% from 35%. This again proves that the occupancy and rental revision is on the uptrend. I think this is a very favorable way for Centurion. They could see growing profits in the coming quarters ahead. And I wonder if Centurion can repeat this multi-bagger as what I've seen in 2013, 2014. At that point of time, they grew by 2.6 times. I'm thinking, could this be a leg up that we see similar to this? And if that's true, that could be hugely rewarding if you are a shareholder. I rate this stock pretty highly, and it's good to see the CEO has even made some purchases using his own money. Small amounts, $75,000 of shares, done on 10th of May at around 50 cents. Then in June, Chairman has actually used more than 100,000 of his own cash to buy in at 53 cents. Keep that in mind, and let's move on to the fourth company, which is where we'll be allocating $40,000. Now let's do a quick recap. We'll be allocating $10,000 to Raffles Medical, $20,000 to SATS Limited, $30,000 to Centurion. That leaves us with $40,000 of this $100,000 investment. Again, this is not financial advice. This is just discussing what is a very ideal situation that you can allocate towards companies that can grow in share price potentially and pay you dividends. Revealing who this 40,000 allocation is none other than a company that I currently already own and has recently reported very, very good results. This company is Baosteed. Let me share with you what Baosteed's business exactly is. They own 4 key business segments. The first is energy engineering. If you're not in the engineering space, just understand this as some industrial and oil and gas related services. It is a staple for Baosteed. The next below is geospatial. This, if you have seen my previous tutorial, is the crown jewel. Baosteed actually has a license from ESRI using their technology to provide a lot of services, and I'll explain more what you need to know about it. And to his right is healthcare. This is still a small segment, so let's discard it away. And on top of it is actually real estate segment. Recently, Balstead has actually privatized Balstead Projects. And if you don't know about Balstead Projects, maybe you have seen before Razer HQ when you drive around AYE. Razer HQ was developed by them, and Balstead has actually very nice design solutions, which is their key advantage. But this real estate segment is very lumpy in terms of performance. And to explain that, let me pull up last year's annual report to show you the margins as well as how to understand who are the key contributors. Over there, the 4 segments, energy, real estate, geospatial and healthcare are all shown transparently. Real estate right now being privatized will contribute even more. But what I've actually boxed up over there is geospatial. You would realize that in terms of total revenue, they are not the biggest contributor. But in terms of total profits, it is the key segment. And profit margins are very healthy at more than 20%. This alone is why I invested into Balstead. And when I saw that this division delivered record earnings, I was ecstatic. Geospatial division has broken the 200 million mark, clocking 212 million for financial 2024. If we were to use a 20% profit margin, there will easily be 42.5 million from this segment itself. Then the next part is the energy engineering division. This has also delivered a sizable year-on-year jump, but that's also because last year was kind of a suppressed year due to a COVID hangover. With 174 million, I expect profits from this segment to be at least $22.5 million, which means 30 plus million is actually coming from the real estate solutions side, Balstead Projects. Not too bad, all 3 key segments are firing quite well in profits. But again, I'd like to draw attention to the geospatial division. This is a technology that allows government agencies and companies to do planning and surveillance work. As you can see, the market sectors that it serves is huge and diversified. I remember during COVID, government agencies were even using its technologies to map out how to actually do quarantine and lockdown work. If we were to see on top the division profit before income tax, this shot out in 2021, correct? Because COVID actually drove more service demand. And right now, as I guess, this could be at least $42.5 million. And if we draw a compound annual growth rate, this looks very healthy, correct? In my eyes, this segment itself is already worth the entire market cap of the company. And I've actually further good news to share with you. Chairman Mr. Wong has been buying his own stock also in the last few months. His highest purchasing price is around 92 cents. So if you can snap something around there, I think you are buying at an insider price also. And to add icing to the cake, I'd like to share with you also that Balstead is net cash in position. Interest rates go up, no problem. They are making more interest income, like Berkshire Hathaway. Current net cash is 48.4 cents of its NAV of $1.05. And with that, Balstead is raising its dividends. It will be paying another 4 cents, which means for the year, it has paid 5.5 cents in dividend. Hopefully, dividend continues to grow with good performance from the geospatial segment, and that's why I'll justify to allocate 40,000 towards there. Thank you for watching right at the very end. As always, let me know in comment sections what are the names that you think I can add on to the list further, and I have a special video to introduce you, which is why I'm not buying SIA. SIA has actually paid good dividends, but I have a reason why I wouldn't buy into it. With that, I'll sign off from here and see you there. Take care as always. Goodbye.